Ahoy there, trader! Is the correction coming? Shh, it's always coming. So let's be clear right now. Corrections are nothing to be worried about. So yeah, I said it. So you can stop wetting your pants over a possible correction and focus more on making winning swing trades. Because the correction is coming. Because it's always coming soon. Now, one of the more scary events that can happen to new and older traders alike is to be caught on the wrong side of a market correction. And thankfully, it's only happened to me twice in the last 27 years, and I've survived both times. And I've continued to thrive by using the principles and strategies I teach all of my traders, which I'll be mentioning here today. So there's no need to fear the unknown. A fear of an uncertain tomorrow in the stock market can and does create all sorts of stress, and especially so for new and inexperienced traders. So there is no need to fear the unknown. The fear of it happening, the fear of losing unrealized gains from positions makes those traders take some weird actions or even inactions like a startled deer in the headlights. So once more, there's no need to worry. Today we're going to demystify corrections and crashes so that you will never fear a correction again. I'm going to show you trade management tactics and de-risk your trading portfolio. And when you do this right, you'll actually welcome a correction. The best way that we can never fear a correction again is to arm ourselves with knowledge. So if you're ready for that, stay tuned and let's get into it right now. Now, before I tell you exactly how to know when the next correction is coming, and in case you've never heard of me, here's a quick 30-second introduction. My name's Phil Newton. I've coached thousands of students with my programs, and I've personally mentored 756 traders, a number which continues to go up every week, from retail traders through to hedge fund owners, banks and institutions, and I've appeared on some of those fancy media outlets that you can see at the bottom there. I love a good read over a coffee, and I'm not a Wall Street guru. I'm just a regular guy who figured a few things out and found his success, and I want to help you see your success. So from here on out, I'm going to be your personal swing trading mentor, and every week I'm going to give you the no bullshit insider information on how to find and profit from swing trading stocks, create wealth, and live your best life. Because I've cracked the code, it's simple and it's easy to replicate, and you don't have to take my word for it. You can hear it straight from my past students who are consistently seeing amazing results using production line trading. Like famed author, investor and entrepreneur Anik Singhal, who says, I rarely pitch anyone or promote things, but I do want to hear because he is that good. Just like Joe Fair, a renowned podcaster, investor and entrepreneur, who says, there's no need to get fancy. I follow Phil's guidance and use my best judgment based on my circumstances. It makes trading more straight line approach and is very methodical. And Steve Dalder, a famed local professional musician, who says Phil has a way of explaining things that make you realize that this is not beyond you. It's a system with proven results and it's something anyone can do. Plus, it's great fun. And they're not isolated incidents. I have hundreds, if not thousands of students that tell me that they are seeing their success. It gives me and them time freedom and financial freedom. So the correction is coming because it's always coming, and once again there's no need to worry. So before we look at some of the solutions I use that should be in every swing trader's toolbox of strategies, we should first look at corrections in a little more detail so that you're no longer fearful of a correction, or a crash for that matter, which I've talked about in a separate video documenting a study of crashes. So let's define a correction very quickly. It's going to be at least 10% in 10 days because of the speed of movement is a factor for these types of corrections and crashes. Because let's face it, slow and steady movements don't really scare anyone. It's the bigger moves that happen in shorter time spans that put the willies up them. So when you start to study these types of moves, you'll spot that they do not happen often, but they do happen with a degree of regularity. So let's look at the evidence of this. I'm looking at the chart of 2020, and the right hand side of the chart is the 20th of February. Now I looked at this earlier this year. As I'm doing this, it's the middle of 2021, and I looked at this exactly on the 20th of February. Now why that date? Because it was the anniversary of the crash back in February 2020. So in February 2021, I was looking at that anniversary date. So what we can see is we can see a crash on the left, which is February, March. Now in the middle of the chart, slightly off center to the right actually, we can see September, October, and there's yellow boxes along the bottom of the charts to highlight these areas. So originally my observation, and for many years actually, it was anecdotal. I've always known that corrections happen because after a period of time, you start to notice things. So I noticed that it happens regularly and it happens at certain times of year. So to try and quantify this so that I can explain it to you and all my other students, we need to firstly make the observation, which is anecdotal, and then study it. So that's what we're going to do right now. So what I've noticed is that if we just look at last year again, in February, March, I noticed that there are certain corrections. Now, in 2020, it was a crash. It was a huge movement. So it is, these corrections can lead to crashes. So if we study corrections, we won't be scared of crashes either as a byproduct. Now, what we can also see in September, October time is that there were corrections, those smaller moves. That's the one that I'm really looking at. So when you make that observation and then you start to go back to the previous year, we're looking at now at 2019. We don't see it quite in February, March of 2019, but we do see the correction in September, October of 2019. And if we continue to go back, you will see that time and time again, the corrections happen around that time of year. Now, always there's going to be some exceptions to every rule. I just want to go back one or two slides. We didn't see it in 2017. We didn't see it at the beginning of the year, at the end of the year. The following year, we saw it twice, at the beginning and at the end. So it can skip a year. It's not cast in stone, as the saying goes. But what we can see is that there is a high degree of regularity, that these corrections happen February, March, this is 2014 now, going into 2015, with a degree of regularity. And if we go back to 2013, going into 2014, again, you can see the corrections happen with a degree of regularity. So on the 20th of February, 2021, I posed this same question. Is there going to be a correction February, March? And the date was especially important because it was the first year anniversary. So that's why it was, I could get even more specific, because the market's essentially a representation of human behavior. It's crowd psychology in graphical form. So when we look at 6 months later, so this is the chart right now, the vertical yellow line is the 20th of February 2021. We can see that there was a subsequent correction. And we were talking about this in real time at the time, and it wasn't a surprise for us because we were expecting it. So we have a lot of anecdotal evidence. Visually, we validated that actually it looks like there's usually a correction February, March, and September, October time. It's on the charts. We've proven it multiple times. So now that we've got a working hypothesis, we can explore that data in more detail. Now, there's plenty of services out there that will collaborate and collate and fine-tune data for you. This is one such service. And what it's done, I've now gone back and said, let's look at the last 150 years. It's taken all the data that's available on the Dow. It's smoothed it out, it's run it through its algorithms, so it's detrended it as well. So we have this graph in front of us that allows us to compare year on year and look at the average year on year, month on month. And for me, this, looking back chart after charts that we've just done, it helps us give us a visual cue, a visual blueprint. It validates a hypothesis. But when we look at the actual data, there is a seasonal trend. There is a cyclical nature to the ebbs and flows of the market. And not just in the last few years as we initially looked, but when we look back over the last 150 years, because there's enough data for us to do that, we can see that there are seasonal cyclical trends in the market. On the left, we can see February, March. There is, historically speaking, a cyclical or seasonal downturn in the market at that time of year very regularly. Similarly, we can see September, October on the right. There's equally a seasonal or cyclical downward movement in the market at that time of year. And we can spot other trends through the year. We'll look at those later on. But the point I'm trying to get to is when it comes to corrections, there's no need to worry. We know that they're going to happen because the correction is coming, but we also know when they're going to come. They happen once a year on average, usually February, March, or September, October. It might skip a year, 1 year. We might get both in 1 year, both the times, February, March, or September, October. But typically, we're going to get it once a year. So they're nothing to worry about because we know they're coming, and now we know when they're coming. So when we know this information, when we're armed with this information, we can start thinking about correction protection. We can start to de-risk the situation. So some of the things that I teach all of my traders inside my programs are my 3 pillars of trading success. These are trading principles for maximum success, and anyone can apply them to their own trading strategy. And if you need help with a trading strategy, we can talk about that later as well. But the first thing we always want to do is trade small so that we're not scared of a correction. You know, if you have a downturn in your portfolio or positions, if you're trading small, sensibly small, then it's not going to have a minimal impact. You're not going to stress over blowing your account up. We also want to trade frequently, not pew just for the sake of placing trades. You should trade with the frequency your strategy sets up. For example, I've got one of my portfolios looks at a universe of stocks of 50 stocks. So that I'm only looking for opportunities inside of 50 stocks. That's my universe. I'm not looking at the 28,000 stocks that I could look up that are listed on the US markets. It's 50 of the best stocks. And I'm looking for certain setups only on those stocks. So the frequency with which my strategy sets up on those 50 stocks means that I get 2 or 3 trades every week. So I place 2 or 3 trades every week. I'm not trying to place 20. I'm not trying to cherry pick the best one. I'm placing all 3 on average. That's what I mean by trade frequency. You can't pick the best one because we don't know which ones are going to work. What I do know is that I've got a positive expectancy strategy that on average wins 63% of the time, and it produces 85% return on capital for every trade I place. I know that because I've got a strategy. It's time-tested, proven, and backed by data. So I trade small, which allows me to trade frequently because I'm using a proven strategy. And that's what you should do. So I'm assuming you've got a strategy. So if you apply the other 2 pillars, you trade small, you trade with the frequency it sets up in a sensible way. And don't try and trade everything is the point. You should not need to look at however many hundreds of thousands of stocks that are in the known universe of stocks. Stick to your lane. Stick to the stocks that make sense. Stick to the stocks that are better or more ideal for your strategy. The other thing that you want to do is trade both sides of the market. I'm a swing trader. I will profit in bullish swings and bearish swings in the markets, meaning that I'll profit from upward and downward movements in the markets. Think about that. You can profit on both sides of the market. It doesn't matter which way the market goes. The other thing that we can do to, again, protect against corrections and crashes is I can use stock options. I can use them in the classic sense. For risk mitigation. I can basically buy puts, and there is a cost involved with this. It costs the premium. But we can also look at some advanced option strategies. I tend to use stock options as an alternative to trading stock. It allows me more efficiency in my portfolio. It's more capital effective, and I can trade with a frequency that makes sense to my account. So I teach all of my students what most people would consider advanced option strategies. And from a management point of view in relation to our correction protection, you can start to apply things like put ratios. And you can set up a risk a cost-free insurance, essentially, against crashes and corrections. Now, it's not risk-free, but it won't cost you anything if you set it up right. You can buy puts and offset that with a credit spread, for example, and it's cost-free. So if no correction happens, it doesn't cost you anything. Think about that. You can buy as much insurance as you want for zero cost. Now, obviously, if there is some movements, there is a risk element to it. Just like any trade, there's always going to be a risk, but it's not going to cost you. There's going to be no out-of-pocket expense. Things I like to do something called gamma scalping. It allows me to lock in profits. It allows me to de-risk in a long-only environment, because we're in a long-only environment right now. I would prefer to have bullish and bearish trades on at the moment, but there's nothing bearish setting up. We're just coming out of a crash. Everything that could go down has gone down, has stayed down. So there's very few, if any, bearish opportunities. So I can scalp the gamma and de-risk my portfolio by having short exposure in a very smart, very sensible way. It acts as a hedge, it gives me crash protection, and it gives me correction protection. So I don't have to worry about what the market is doing, even though I've got a long-only portfolio. Again, think about that. If you've got a 100% bullish portfolio, you can still profit and benefit from corrections and crashes. It's a wonderful place to be. Final thing that we can do, as we've touched on, you can actually use the seasonality. We've made an observation. We can take this and explore it further. We've noted that there are certain times of year that have corrections. So what we can start to do is use seasonality, use cycles to plan your trading year. And I've just highlighted some of the main ones based on the chart that we've seen. Start off at the left, January, all the way through to December, 12 months in between. The red boxes we've already looked at. The corrections that happen cyclically and seasonally on a regular basis. At the beginning of the year, there's often a lot of fund rotations. So there's usually a rally at the beginning of the year. Could I increase position size to compensate and take advantage of the January, February rally that often happens every year? Well, I'm sure I could. Now I'm thinking about it. Could we take advantage of that old adage, sell in May and go away, the summer doldrums? As I'm recording this, that's where we are right now. We've got the evidence right in front of us. There's still movement, there's still pockets of movements, but May, June, it's usually a lot quieter than other times in the year. So maybe I reduce the frequency, look at a fewer number of stocks in my universe, the wellspring that I draw from, so that I'm not got a huge exposure in a typically quiet period of the year. But here, hey, next up we have the June, July summer rally. So then I can start to ramp things up to take advantage of what could be a summer rally. We've already explored the September, October sell-off. And then just going into the end of the year, we've all heard of the Santa rally. You know, these things are phenomenons that happen. So when you start thinking about, well, what other cycles and what other trends are there? We know that corrections happen once, maybe twice a year at certain times. Well, equally, there's rallies happen at certain times of year that are very predictable. So take advantage of this data, this information that's freely available to everyone, and take advantage of the situation. Coming back to corrections, when's the next correction? They happen once a year on average, February, March, or September, October. And interestingly, the corrections often, if there is going to be a crash, they start with a correction. Now, a crash happens, as we've explored in a previous video, they happen once every 10 years. We've just had one. So what are the chances of seeing a second crash in 12 months, in the next 12 months, in the next 2 years? I'm not saying it can't happen, but the probability is exceptionally low when you look at the historical nature of the markets. And we've got hundreds of years of data to explore, to look back on. On average, crashes happen once every 10 years. Corrections, 10% or more in 10 to 20 days. They happen once a year on average, either February, March, or September, October. So once again, there is no need to worry about the correction because it's always coming soon. Now, if you need some help with the strategy element, I always make the assumption that you've got your own strategy. I always talk in reference of my strategy. I refer to it as production line trading, which is the smartest way to swing trade stocks. And if you'd like some help, there's 3 main elements to it: the mechanical scan, the visual blueprints, and we've talked a little bit about the profitable trade framework, the planning and the management rules. Now, because it's a production line and it's replicatable, it means that you can replicate. It's not just me saying it. We've demonstrated it before in the past recordings. It allows me to find profitable trades. It also allows my students to find profitable trades and tell me that they're seeing great successes and great results. So if you find yourself stressing over what the markets are going to do tomorrow and you're zombie trading and you're flicking through chart after chart wondering what to do, and you want some personal help and you want to learn how to swing trade stocks in the smartest possible way, I do have an all-inclusive mentorship program. You can learn my production line trading process in the next 7 days or less, usually in under an hour a day. We'll focus on the best stocks, the best patterns to trade, proven and driven by decades of data and real results. We'll focus more on my TTE trader management system. We touched on a little bit about that earlier, which is the real secret to success. It's how you manage the trades. And once you've mastered it, you can spend as little as 20 minutes increasing your results over the next 90 days. You'll build your trade confidence so that you can transition into the best possible trader that you can be. And you will never have to zombie trade again. You'll never be spending hours after hour flicking through chart after chart. You won't be stressing over what the markets are doing. In fact, you'll get confidence by profiting in both directions. You will never have to read boring company reports trying to divine some sort of value. And you will profit from swing trading. And typically my trades last about 20 to 30 days and potentially up to 90 days in any market condition with the way that I teach it. So my invitation is, do you want to be next? If you'd like to learn a little bit more about it, very simply go to productionlinetrading.com. That's all one word, productionlinetrading.com. Or you can click the link above or below this video, and it will take you to another page where you'll be asked to input your details, and you'll be able to watch a short 14-minute presentation that just goes into a lot more detail, and you'll be able to make an informed decision as to whether this is right for you. So click the link or go to productionlinetrading.com, and I will see you on the other side.